So the market finally got its 25 basis point rate cut today, and I don't think it came as a surprise to anybody. The dot plot was interesting, only in the sense that, they lowered the forecast to 3.6 from 3.9, suggesting another two rate cuts this year, and they pushed off the target of getting to inflation until 2028 now. So I guess at some point in the not too distant future, we'll get back to inflation at a 2% number, but unfortunately it won't come under Jay Powell's leadership because he'll be long gone by the time we get back to target, at least based off of this projection. I guess the one thing that really stood out to me was the lone dot all the way out here for 2025 below 3%. I mean, it's kind of interesting, right? Because if you take there's 19 voters, and if you count, 9 dots or 10 dots to find the midpoint, you're at 1, 2, 3, 4, 5, 6, 7, 8, 9 would put you, more in this 3.75 to 4% range. But if you go to 10, it slips down to 3.6. So, if you hadn't had him as a voter, let's say he didn't come on to vote until after the Fed meeting, then you would have had a median dot that probably priced somewhere around 3.8 or 3.9%, which would have been unchanged from last month, from June. And maybe the market kind of saw that and looked through it and realized that this was sort of the outlier. Obviously, we're not going to see rates below 3% before the end of the year. I mean, it would take very significant number of rate cuts between now and then. So I think that's probably highly unlikely, barring some sort of major recession developing between now and then. And so I think you kind of see that the Fed is delaying getting to the 2% target, and that the number of rate cuts that the Fed is kind of promising this year is a little bit not as rosy as a picture as the number might seem. And really, you could see that in the reaction of the markets. And I think it was interesting. I had kind of, joked on X earlier in the day and said, what if, the next move in 10-year rates isn't lower but higher? And I still happen to believe that could very well be the case. If you just look at the 10-year on a technical basis, we did come down outside of the Bollinger Band for 2 days. We did see the RSI hit 30, just below 30. And now you can generally see the RSI starting to trend higher. And it's quite possible that we could see, the 10-year rate get back to and test this 4.16% 20-day moving average. You can see we closed right at the 10-day exponential moving average. So there's a good chance that we could actually see 10-year rates start moving up from here. Again, how high they're going to move, I think, is going to largely depend on the flow of economic data we continue to get. But if you look at this chart here that I was looking at earlier today, and I put this in the free write-up tonight, if you look and you look at this on a historical basis, right now the 10-year only trades 11 basis points higher than the 3-month Treasury. Who would want to own a 10-year Treasury at essentially the same rate as a 3-month Treasury? I would think that you'd probably want to take the shorter duration for as long as you possibly can. And generally speaking, if the Fed is looking at a 3%, if you look at the Fed's targets, 3%, neutral rate, it looks like they're telling you that they're going to stop cutting rates at 3.1%, and that's where we're going to settle out at. And when you look at where, Fed funds are pricing, you get the same sort of image, right? Where you get 2026, December 26 at 2.9, and you see rates going up in 2027 back over 3%. So, if we're looking at a 3-month Treasury that kind of bottoms out somewhere around, call it 3%, and we kind of just, work off of some past trends, what you kind of walk away with is this impression that, you could see the spread between a 3-month Treasury and a 10-year yield up somewhere around 2%. And if you're going to be at 3% on a 3-month, and you're going to be 200 basis points above that, then that would kind of argue for a higher rate on 10 years, possibly as high as 5.25 to 5.5%. and maybe even as high as a 6.5 or a 6.8 number. I mean, it's not. It sounds crazy, but it's not really out of the realm of possibility when you look at where 10-year rates have typically historically traded above 3-month. And so again, like, this just goes to another point that it's quite possible that the next move we see in Treasury rates isn't necessarily lower, but it's actually higher. And you can see here what looks like a pretty nice bull pennant that's formed in the 10-year rate on a monthly chart going all the way back, let's say, to February of 22. And if you kind of just project this out and you draw it from the bottom, I mean, you can get a 10-year that goes to 7.5% just based on that technical analysis alone. So I think that there's still a very good chance that you could see rates going higher from here and not necessarily lower, just because the Fed is cutting rates. And I think that's one assumption that a lot of people are making that may not prove to be the right assumption. One reason why that could be is, well, if you look at inflation swaps, 1-year inflation swaps were basically flat today, but 2-year swaps traded up to 285, and the 5-year swap traded up to 256. So, again, there's still this threat that there's this inflation out there that could really be what drives rates on the longer end of the curve higher. And when we look at things like the yen, it looked like, today we were going to get a breakdown in the yen, and then the news came out, the yen really started to strengthen, but then it snapped back. We'll have to just see what happens with the Bank of Japan over the next 2 days and what they do in terms of where their interest rate policy is going to go. It's pretty clear that the ECB is probably done cutting rates, and so that could clear the way for the euro to continue to actually strengthen versus the dollar. And then when you look at Germany, Germany's market's actually been struggling now the last couple of weeks. I mean, there's a possibility here that if we break below 23,300, call it, we could be looking at a DAX that starts slipping. I mean, when you look at some of the individual components that make up the DAX, like SAP, it certainly doesn't have a very bullish look to it. When you look at Rheinmetall, which is the big defense contractor in Germany, it's obviously had a huge move, and you can see that it's potentially putting in some sort of topping pattern here too. Again, we just have to watch how that kind of plays out. When you look at Siemens, that's not really looking very strong. So, I mean, there's a case to be made that maybe you're starting to see some weakness in Germany in the DAX, and here's your stock here's your stocks 50, certainly hasn't really done very much more recently. And then, of course, we have some of the activity in Japan, which is, if you look at the Nikkei, it's gone really crazy. But there are things going on there that I'm just not getting, because you've had shares of SoftBank just literally go vertical. And then when you go over to Korea, the Kospi has also made a very big move higher, but again, you've had some really crazy moves in stocks like SK Hynix, which is up, some, ridiculous amount since basically April, up over 100%. And so, again, this is one of the bigger names over there. And when you look at Samsung, which is the biggest, that's also had a pretty big move more recently. So you've had a lot of really weird moves in that part of the market that may or may not be distorting some of the setups over there. And when you look at the S&P here, again, there's a possibility here that we have what looks like a rising wedge pattern. It's certainly much more visible when you look at it on the RSP. So, I mean, today we saw a lot of volatility in the S&P, and I think that was largely because of the rate announcement. We also knew that implied volatility on the VIX one-day was very elevated going into this announcement, and so you saw the VIX one-day climb yesterday up to around 16. It ended up opening around 14, and then it continued to march higher. I would expect it will continue to fall tomorrow until it gets back to something that's a little bit more normal, say around 11 or 12, and then we'll be pretty much reset by the time we get to Friday. But essentially, that's what basically saved the S&P today, at least, because when you look at the S&P and you overlay it with the VIX one-day, you can see that, essentially, the S&P was really declining. There must have been a lot of sellers that came in, because you can see that as soon as that Fed announcement comes out, VIX one-day comes down, S&P 500 shoots higher, VIX one-day comes up, S&P comes down, VIX one-day goes down, S&P goes up. And then we got into this holding pattern. That's when the sellers came in. And then you finally got that vol crush starting around 250. And that's when you really started to see the S&P 500 recover by about 85 basis points. And that was really all we were able to manage. You know, it's impossible at this point because I think it all comes down to basically what, you know, a handful of stocks are going to do. And, you know, Nvidia obviously is the ringleader here. And, you know, now that China is not allowing Nvidia to sell its GPUs anymore, you got to wonder, you know, how that plays out. But this is the zone that's really important on Nvidia, between 165 and 170. You know, the last couple of times we've gotten there, we've tested it. Clearly momentum is negative, but we need to get below this 164, 165 area if you're bearish, because then you can start thinking about, you know, the stock coming back down into the low 150s, upper 140s. And that's obviously going to have a fairly decent size impact on the overall market. Anyway, hope you enjoyed this video. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon. Bye.